Hi, this is Binu Joseph from Inditrade. After 4 weeks of rally of nearly 20% in rupee terms and 30% in dollar terms, chances are there the uptrend has come to a halt. Last week, the two central banks surprised the markets with their policy actions. US Central Bank on the positive side and RBI on the other side. This week there are not much domestic data to watch, and the main event is the expiry of the F&O contracts on Thursday 26th September. The daily data on FII inflows now become a deciding factor. After the US Fed decision to continue bond purchases, the fund inflow is 4,500 crore in cash market in the last 2 days. If ETF flows continue, then market could sustain at this level. The last weekend, the US and European stocks corrected after Federal Reserve Bank of St. Louis president said that a small taper in fiscal stimulus is possible on October meeting. This is not good news for emerging markets this week. Fed will take cues from the September jobs report and updated housing reports at its next meeting on October 29th and 30. The other US data to watch are second quarter GDP, consumer confidence, and new home sales. In German elections on Sunday, Chancellor Angela Merkel secures a third election win, becoming the only leader in the Eurozone to be re-elected since the starting of the Eurozone crisis in 2010. There will be no post-election shift in German stance on Euro crisis and would not have a meaningful impact on equity markets. The HSBC China flash manufacturing PMI data on Monday 23rd September came at a 6-month high, could improve the sentiment slightly at the start of the week. The US Congress is discussing two important issues in coming days. One to fund the government, the other to increase the amount of the amount the US can legally borrow. Every federal agency is due to shut down from October unless the Congress can reach an agreement. The Republicans said they won't pass those bills unless all the funding dropped for the Affordable Care Act known as Obama Act. Wall Street Journal reports that Obama is never ever going to unwind his project of national health care. Yet the risk of a government shutdown on October 1 is now a distinct possibility. Key Democrats and Republicans said on Sunday that they expect the Congress to somehow come together and avert a US government slowdown. However, this political uncertainty will add worries for global stock indices in coming days. Now a technical view on Nifty. The weekly chart of Nifty shows positive trend in MACD, stochastic, RSI, and weekly candle is showing positive trend. However, some of the indicators in the daily chart are showing negative divergences. The slow stochastic is in overbought zone and turning down. Percentage K line is below percentage D line. The ADX indicator shows a slight divergence. During the recent market rally, the ADX indicator was almost flat, and at some point of time it started coming down. But on the last Friday, during the index decline, it started moving up. Shows the weakness getting more momentum. The RSI value is almost came near to 70 in previous week and currently stands at 63. It recently touched the upper line of Bollinger Bands and started correcting from there. In the past many times the RSI corrected slowly after touching the upper band. This shows that in the short term the uptrend could be under pressure and more possibility of a prolonged downtrend. However, the MACD is still very positive. The index is now at the upper band channel of regression lines, and this also not very supportive for the market. Now the critical support level for Nifty this week is at 5910 level, and if FII flows support, market can stabilize above this. The first hurdle for market is at 6091 level. The major short term resistance is at 6230. However, if market close below 5910, then we can expect more momentum on the downside, wherein which the first support comes at 5802 level. If US political uncertainty plays a big role on market sentiment later in the week and a fall below 5802, then the index could move towards the major support at 5678 level. Thank you for watching the video. Disclaimer.